And Ian, could you lead us in the pledge, please?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Is there any public comment today? Okay. The consent agenda, is there any discussion or possible action regarding the consent agenda? Okay. Yes.
Okay, now, sorry. Well, are we on the minutes yet?
Yes.
Okay, the minutes, the last page had a 2019 date, that's all.
Judy found that and corrected it.
Okay.
Okay, thank you.
We just want to see if any of you are really reading it.
Notice.
It's the brown M&Ms.
It's that time of year, the transition.
Yeah, I'm seeing them on.
Nothing gets past.
Are there any other comments or corrections, discussion? Okay, so noted, by popular consent, we'll move on to discussion and possible action regarding investment matters. Good morning.
Good morning.
So,
We got another chair.
okay, thank you.
Good morning. So good morning, it's good to see you. Claire and I have 3 items to talk to you about today. The first is an overall update for our capital market expectations. The second is a performance report, and the third is our work plan for the year. So we'll spend about 20-25 minutes on capital markets, and then performance, and then the work plan should be a relatively quick discussion. So we'll try to stay on point for you today. So we have this summary presentation here, which is on your work pads. And if you flip ahead to page 3, let's just remind you why and what we do here on an annual basis. We come up with return expectations forecasts for major asset classes, and also come up with assumptions on volatility and correlation between asset classes. And we do this to help you make a long-term return expectation. So we're not forecasting what's going to happen next year. We're forecasting what we think will happen over a significantly long planning horizon for you. Call it 7 to 10 year time period. So not next year, 7 to 10 years, and also importantly, from your actuary's perspective, we're also not talking about 30 years, because believe it or not, what you expect over these 3 different time periods can be quite different from one another, whether it's 30 years, 10 years, or next year. I personally don't think you can really predict what's going to happen next year, but we're focusing on 7 to 10 years. There are a few important things we believe you should do some research on when you're coming up with that 7 to 10 year forecast. What is GDP growth going to look like? What is inflation going to look like? And what's the current valuation of asset classes? So those are the 3 primary inputs we look at every time we come up with our capital market expectations. When we came in here last year, we did a similar presentation, and we told you what we think your earning power is going forward. You roll ahead a year forward, you returned about 20% last year, which is an outsized return. Not beyond forecast, it's within the range of reasonability, but nevertheless, we have to take that into consideration and say, okay, going forward, we don't think the returns are going to be as high as we had predicted last year. Our 7 to 10 year forecast is coming down a little bit, and that's largely because of our fixed income expectation interest rates fell meaningfully last year, and importantly, the market's anticipation for future rate increases came down, which means the earning power for bonds for the very long time has come down. So our return expectations came down year over year for you. Okay. Your actuary is less sensitive to shorter term valuation changes for us, so they might come up with a different number than we are coming up with. And we've all dealt with these differences over the past several years. So let's flip ahead to page 4 here and just level set you about what the year looked like. And here on the right-hand side of this chart, we look at the returns for major asset classes. A few big takeaways here is that large cap stocks returned about over 30%. Small cap stocks didn't keep up as much, only up about 25%. Well, who can complain with that? Right? 25% return. International stocks were up about 20%. Bonds up about 9%. And long duration bonds were up about 20%. That means interest rates came down meaningfully during the year. Real estate was positive, up about 6%. Notably, real estate had a run up from multiple years prior to that. Hedge funds were up about 9%, commodities up about 8%, gold up almost 19%. All of this happened when inflation was running at about 2.3%. Okay? So very strong returns for the last year. Inflation remains subdued. Okay? We can't expect returns like this to continue going forward. Now, if you scroll back to the past 10 years, most investors should be extremely happy with the performance of long-term portfolios for the last 10 years. If you look at this chart, U.S. stocks up on average 12 to 13%. International stocks certainly disappointing, up only 5 to 6%, and then bonds up a little under 4% for the last 10-year time period, while real estate, the other asset category in your portfolio, is up about 10 percentage points. So on page 5, we mentioned that last year returns were up about 31% for the U.S. stock market, and then we asked the question, well, is that abnormal or not? And so one graphic way to look at this is to say, okay, what if we take every calendar year return for the U.S. stock market and plot it in 10% increments, and just graphically show what's the distribution of returns generally. And so we stack all of these up, in the most recent years are at the top. And if you step back and you look at it for a minute, one of the big takeaways is this does kind of look like a bell curve, right? Remember that your statistics class, it kind of looks like a probability distribution here, right? And then last year at 31%, that looks like about a 1 standard deviation event. And that's pretty darn close to what it was, maybe just a little bit more than that from our estimations. But it's pretty much in the heart of, it's within the normative part of the distribution. It's not a tail event. The last tail event we experienced was back in 2008 when we had a negative 37% return. So that is certainly a scenario that we need to plan for and be prepared for, because those scenarios do happen. And then last year was up about 31%, great year, but also not quite the normative. I think we should also remember that 2018, because of fourth quarter last year, we actually posted a negative return. U.S. stock market was down about 4%. And the investment program had a negative return in 2018. Last year's really significant 20% return certainly erased a lot of that. Now, flipping ahead to page 7, I mentioned a few things that we really focus on, GDP growth, inflation, current valuations, when coming up with a return expectations. On page 7, we look at GDP. And we are currently in the longest expansion, GDP expansion, that this economy has seen since the 1900s. So it's been going on for over 10 years. But if you look at the bottom right-hand chart, you'll see that while it's been going on for a long time, it hasn't been quite as robust as other rebounds has been. So it's been a slow burn for a long time. So because of the length of it, a lot of people are wondering, well, does this mean it has to end? And expansions don't die of old age, right? There's nothing, they are killed, right? But they don't die of old age. So imbalances or shocks to the system tend to end expansions. It's not just that they've been going on for a long time. So we're not forecasting an end to the expansion just because it's been around for a long time. There's no reason to believe it. But if there are imbalances or shocks to the system, it certainly can end the expansion at some point, but we don't see that imminently. Later in the presentation, you'll see that our expectations for GDP growth remains to be about that 2 to 2.5% range. So continuing on this trend that you see in the bottom right-hand chart. Why is that? Well, on page 8, one of the big drivers for our economy, about 70% of our economy is driven by the consumer. What we do personally drives the economy 70%. What companies do and transfers between countries accounts for only 30% of the economy. If you look at on page 8 here, the big takeaway here is that unemployment remains really low and arguably below what the natural rate of unemployment would be. So that means we as consumers feel really good, our consumer confidence is high, and we're spending money. So that's very supportive of the economy. On page 9, on the right-hand side here, on top of that, this is the participation rate. More of us are coming into the workforce, so that's a good thing. I was thinking about page 11 here, so I'll flip ahead to here. On top of that, one of the big things that happened in 2018 and 2019 is we started to see hourly wages increase. So not only are more people working, but they're getting paid a little bit more. Their rate of payment growth is increasing. And to date, most recently, it's been increasing a little bit more than inflation, which is really good. So people are employed and they're making money, and they're making more money than they did before. This has been a sticky point for the Federal Reserve and something that they've been wanting to drive: inflation and wage inflation. Now, even though wage inflation has been picking up, we certainly haven't seen it percolate through the economy to get a broader increase in inflation. And that is something that the Federal Reserve is focusing on to create, as I mentioned. What does that mean for us? It means that the Federal Reserve is likely to keep interest rates low for longer, which is stimulative to the economy and supportive of capital markets in general.
Greg, that seems like the disabled portion seems awfully large when you're looking at the U.S. market.
Are you talking about people on disability?
Yeah.
Yes. And it's above average. And there are probably a lot of social reasons that I'm not too equipped to opine upon about that.
Like definition?
About disability.
Mm-hmm. About Oxycontin.
On page 19 here, flipped ahead, we mentioned that the capital markets increased significantly over the year, and in 2019, one of the main drivers of that was a declining interest rate environment. If you remember, about a year ago, we had a growth scare because the Federal Reserve was increasing interest rates. This is fourth quarter 2018. We had a significant drawdown in the equity market, and then the Federal Reserve sat there and thought, my change in policy is impacting the future growth of the US economy, or the forecasts of that. And historically, the Federal Reserve has had a dual mandate: inflation and full employment. Those are the two things that we worry about in the Federal Reserve. Well, it's become really clear that the Federal Reserve is actually focused on a third thing now, and that's continuing the expansion. You would think that all three of these things are related, and they are. But if you start deciding that I want to continue the expansion, you do start acting a little bit differently than if my mandate is contain inflation and have full employment. So under the old regime of those two factors, the Federal Reserve, there's no reason they shouldn't be normalizing interest rates right now. Right? We have full employment and we have inflation above 2%. Why aren't you normalizing? Well, it's because we want the expansion to continue, which technically isn't their mandate, but that's the way they're acting now. Okay? So the market got wind of that and started thinking about that over the last year. And because of that, they said, okay, the Federal Reserve is going to keep rates low for long because that's their new mandate. That's their true mandate. So interest rates fell across the curve. And you'll see on the upper left-hand chart on page 19 here, we went from that yellow line down to the green and blue line where we are today. So it just, everything went down. So that means the future value of any cash flow went up in value, whether it's a stock or a bond, a piece of real estate. And also it's saying that, well, the future earning power of all of the bonds across the world is less than it used to be today, is less than it was a year ago. Okay, so not only did it lead to the spike in the capital market return, but also the earning power of future investments in bonds went down meaningfully over the year. Okay, and it's because of that dual mandate change. You can see that on page 22. Here the takeaway is the people who control the federal funds rate, where do they think interest rates are going to be going forward? So these are the people who actually have a vote, have a decision to make about what the federal funds rate should be. And here you see their dot plot. So this has become a famous forecasting that they do. So they do this to give direction to the market about where they think interest rates are going to be at the end of 2019. Well, they got that right. That was a joke. End of 2020, 21, 22. So to me, if you kind of like take a step back and you look at that, one of the big takeaways is that whole line is pretty darn flat, right? Most of the time you see a gradual normalization, increase. It looks flat out certainly till 22, and then even their long-term expectation for what the federal funds rate should be is 2.5%. And that's abnormal, right? That's abnormally low. And if you look at page 24, okay, let's put that in perspective. What's 2.5%? It's been a while now, but if you go back in 2005, Fed funds rate was 5%. In 99, it was 6.5%. That's what the world used to be like, right? To slow down the economy, you're up at 6%. To accelerate it, you're down at 2%. Now normative is 2%. So it's just a very different world, which means the earning power for certain investments is much lower today than it was back in the day. Okay, so Flipping ahead to valuations, let's look at the equity valuation. We could start on page 28 here. So here on the left-hand chart, we're looking at PE ratios. And blue are small cap stocks and yellow is the S&P 500. The dotted line is average over the last 15 years. And then the solid line is where we are today. What are the takeaways here? We're a little above average in valuation. Okay. But one thing we take away from this is that it's not dramatically above average. Okay. When if you put it in a standard deviation term, we're about 0.6 standard deviations above average. Okay. So it's not dramatically above average. It's not a full standard deviation, let alone 2 standard deviations above average. So that means when we look at equity valuations, we're not adjusting our equity forecast downward because it's a little bit overvalued. It can stay at this valuation level. It can get higher, it can get lower. We don't have the confidence to say it's going to move one way or the other. So we build our equity forecast not with a starting point and not adjusting it based on current valuations. When we start our bond forecast, we do, for the reasons that I talked about in the beginning. Okay, so a few of the big takeaways is that we expect GDP for the U.S. to continue to run at about 2.5%. In Europe and international, we expect about a 1 to 0.5% discount from that, from GDP.
Do Europe and international have the equivalent of a Fed?
They do. They have multiple variations of their Feds.
And are their interest rates being held as low as ours are?
Lower.
Lower.
Negative.
Really?
Yeah, extremely stimulative in those economies.
Which brings the question, why is anybody other than central banks buying their bonds? Anybody that's forced to buy their negative interest rate investments, why isn't all the money coming here and driving our interest rates even lower? Because now you've got 150, 175 basis point difference. Why isn't that money swimming over here as fast as it can get here?
It is. And that's part of the reason our interest rates are as low as they are.
But there's
And
still
it's also why the
175
US dollar continues to climb. Because you're taking money from Japan and Europe, looking for a place to invest, buy US assets, drives up the demand for the US dollar continues to climb. So those flows are occurring. So why do you buy a negative yielding bond or a bond of really zero, essentially, where you're guaranteed to have no nominal return? It's a twisted logic.
Because you're a central bank and you're mandated to do it?
Or if you're an insurance company and you have capital requirements, you have to hold a certain amount of safe assets.
And domestic assets.
Or if you are a corporate plan that has to hedge a liability to defease a liability, I'm going to make this payment to someone 10 years from now. The cheapest way to immunize it is to buy a 10-year government bond today. And then there's some investment rationales, which it kind of hurts for you to think about it. But let's say you believe interest rates will go even lower, more negative, goes from negative 50 basis points to negative 2. If I believe that, I still want to buy that bond because it'll go up in value if interest rates become more negative. And people make that bet, but that's a bet, right? And then finally, let's say you think there's going to be deflation,
Mhm.
right? So you want to buy a car 5 years from now, and the car is going to be cheaper 5 years from now than today, and deflation is going down 3% a year. If you take your money and you put it in something that declines only 1% a year, you actually have more money to buy that car 5 years from now. It's easier for you to buy the car 5 years from now. So if you think there's deflation, then it's rational for you to invest that way. But it's a pretty big bet, right? That you're betting that the aggregate prices will be going down.
Is the ship or the lifeboat gonna sink faster?
Right. Right.
Is China, obviously they're starting to buy more American properties again. Are they still pouring money into our stock markets?
I don't know.
Or into buying treasuries?
Well, they are I believe they remain the largest holder of U.S. treasuries. So yes, they have, they'll own a lot of those bonds.
And we have obviously less discretion to help if we go into another recession. Or what about the coronavirus? Is that something that you think will impact what China does in the future? Would it possibly?
Yeah, so to me, every time you come up with these capital market expectations, you worry about tail events.
Mhm.
And I think the coronavirus is an example of a tail event. Similar that Brexit is a tail event, how that unfolds, and people have been worrying about that for a long time. And the coronavirus is a tail event risk where, to me, it's really interesting to watch how the market is reacting to it.
Mhm.
In that, in some ways, it looks at it today like a natural disaster,
Mhm.
like you would if a hurricane hit Florida, where, and so this is a very cold-hearted way to look at human misery. So how do you value what's happening to your stocks and bond portfolios? And I don't want to sound like it's, people aren't mindful of the suffering that's going on. But if it's like a hurricane hitting Florida, what a lot of times happens is there's delayed consumption, but consumption still occurs. And in some times there's a spike in consumption, which, so GDP doesn't go down as much as one would think, right? So if the coronavirus is short-lived like that you could see a spike in spending in healthcare-related areas, and there could be a delay in economic activity that eventually occurs, but it's just delayed a quarter. So again, this is just a cold-hearted way to look at the economy. But what if it goes on for a long time? So that last thought, the people who aren't buying iPhones in China today are still going to buy those iPhones. No, they're just going to buy them 6 months from now. But let's say this goes on for 6, 12, 18 months, and economic activity is depressed or permanently impaired, then that's the tail risk event. Let alone if the virus becomes uncontained and it becomes a pandemic and it becomes just part of becomes the flu, right? Like we get the flu today. So yeah, that's the tail risk event where it could have permanent injury to the economy. But right now for the U.S., it's probably taking down a 10th or 2 GDP. And that could be transient. But there is that tail risk event that there could be a real problem there. It's something that I every night I've been reading about it, just trying to see what the latest numbers are and the impact of it. Yeah.
Thank you.
Yeah. On page 37, we're kind of get to the punchline here. So the earning power for the portfolio We have a few different returns here. We show the arithmetic return and the geometric return. So geometric returns take volatility into consideration, and it's kind of the discounting return. So this would be net of fee passive investing. And so the returns that we're forecasting are about 6.6. And so that is a little bit lower than what it was last year, about 20, 25, 30 basis points lower than our forecast from last year. On page 38, we show the distribution of returns, and I think this is useful to show that, okay, so for us to get that 6.5% return, let's call it, we have to absorb capital market volatility over shorter time periods. So what this chart is showing us is that to get that 6.5% return over any 1 year time period, there's a 1 in 20 chance we have a return 31% or greater, and there's a 1 in 20 chance that we have a return down 14% or worse, right? So to me, 1 out of 20 years, how long have some of you been on the board? You know, so if we come in here next year and we say, hey, there's a negative 15 to 18% return, that would not be extraordinary for the amount of volatility in these portfolios, but we do believe that's the volatility you have to absorb to get that 6.5% return over the long run. Any questions about our return forecasts for the year?
7% looks pretty good. When you bring in 30.
Yep.
Okay, great. So I will turn us to page 42 to talk about this investment program. And Greg kicked off with the punchline, which was that 2019 was a really good year for this investment program. The portfolio was up over 20% net of fees. Put that against the 2018 calendar year, which was down about 4.5%, or no, down over 6%. Anyway, negative. Check myself there. And when we put it in dollar terms, the dollars that were lost in the fourth quarter of 2018 were more than made up in 2019, of course. So we'll look at that a little bit more. On slide 42, this is just a good look back over the last 15 years at total plan growth. So when we think about the dollars in total in the plan, how has that changed over the last 15 years? And it's doubled. So 15 years ago, the portfolio was at about 260-ish million, and today we're looking at 563. So that's a good thing. That also has implications for the dollar translation of your investment returns, which we'll look at next. On slide 43, the top chart breaks down asset growth by calendar year for the last 10 years. And on the far right, we have 2019. The green bars in each year here represent net flows, so benefit payments that go out of the plan, net benefit payments. And then the blue bars represent investment gain or loss, aggregate investment gain or loss for a given year. On the far right, 2019, the plan saw over $97 million in investment gain during the year. That is easily the largest dollar investment gain for the last 10 years, so that's notable. Outflows have been pretty consistent to the tune of about $10 million a year. I mentioned 2018 investment loss was just shy of 35 million, again, more than made up for that in 2019. The bottom half of this page looks at just the last calendar year. Again, the plan saw about $10 million flow out. Most of that was taken out of domestic equities, which is where you saw the strongest investment returns consistent with capital markets. And then the $97 million of investment return, you saw gains in every asset category. And you can see that broken out asset category by asset category.
What was the exception in 2014 for the outflow? It's notably less. Is there an explanation for that?
2017?
Yeah, it's 1.4.
That's a good question.
It's
James,
First
do you
year
have an
of the new contribution rates after the experience study. So the contribution rates increased, and that offset part of that negative cash flow.
okay.
And then it continued, and you'll see that typically every 3 years, the net negative will get smaller, and then it grows a little bit the following 2 years, and then it gets smaller again. That's just the normal, when we do an experience study, in the past 10 years, the contribution rates have always gone up because we've gotten more conservative with our assumptions. So,
Thank you.
Asset allocation is captured on slide 44. So we have actual asset allocation of the investment program versus the target on the right-hand side. No changes yet, but of course, the board did approve a change to the investment policy or the target going forward. So we'll see that in coming quarters, and we've got a good update on the infrastructure funding. The plan will remain at 80% growth, 20% fixed income. So including that infrastructure allocation, the domestic fixed income allocation comes down by about 1%. So pretty much stays the same from a target perspective. Where you will see that infrastructure portfolio funded is going to come from domestic equity and international equity. Mostly international, really. So the international equity allocation will come down by about 4%. But for now, as of the end of 2019, actual asset allocation did remain in line with broadly in line with the target. Small differences indicated in the bottom half of the page here, second column from the right. I'll skip 45, that looks at historical asset allocation over time. Again, we'll see a change there going forward as infrastructure is funded. 46, as always, putting your portfolio in the perspective of other public plans. The allocation to public equity will remain higher than peers, even with the infrastructure funding. But you will see a dot show up on that far right bar. So the bottom number there shows that about 25% of public funds have other real asset exposure outside of real estate, and you will now have an exposure there to the tune of about 6%. Importantly, this strategy, as we continue to talk about, has been good. It has led to very good returns versus peers over time, as public equities have been really the place to be, domestic equity in particular. Page 47, a little bit more detail on asset allocation among the different managers, your implementation by asset category. And this looks at the change in assets over just the given quarter. So if you look all the way at the bottom, the total plan increased by about $34 million over the course of just the fourth quarter of 2019. There was a similar loss in the calendar year of 2018, so even just the fourth quarter made up for that. The other thing I check is just balance between investment managers. So looking at growth and value within each category, those intended balances do remain quite in line. So large cap growth balanced with large cap value, mid cap, small cap, and on down. And then performance, slide 48. We have performance for the recent quarter, year, 3, 5, 7, 10, and 15. You can't find 2018 in here anymore. So the last handful of quarters we've talked about how challenged returns have been versus peers. This portfolio tends to be the top dot or the bottom, in the top quartile of peers or the bottom, depending on the performance of the equity market. You're back at the top. So if we look at just the return for the last year, up 20.43% versus right in line with the total fund benchmark, up about 20.5%. That ranked in the 7th percentile of peers. For the recent quarter, the portfolio was in the 3rd percentile of peers. And that strong return, again, as you look out over 3, 5, 7, 10, completely hides the 2018 return, which was a bottom quartile return. This is a pretty stellar report card, and one that, if you'd like to put on your refrigerator, I think it's great. But it has been a good performance for the portfolio. Over 10 years, the portfolio is up 8.6% net of fees, and in the 17th percentile of that public fund peer group.
Thank you.
Yeah.
Thank you.
Thank yourself.
Yeah. And then 49 and 50 breakout fiscal year returns. So I mentioned that the portfolio tends to be the top dot or the bottom dot. Of the last 10 fiscal years, including the fiscal year to date so far, 6 of the 10 are in the top quartile of that peer group, 3 are in the bottom quartile, and only 1 is somewhere in the middle. But again, add that up over time and it has been a winning strategy for the portfolio. Year to date, or fiscal year to date so far, the portfolio, so that's 2 quarters, is up 6.86% and really right on top of that total fund benchmark. So we'll see where the next 2 quarters go. 51 looks at aggregate performance for the portfolio over time. Big punchline, of course, continues to be that your active management and your implementation has paid off over time. The portfolio has more dollars in it than it would have with just passive implementation of the target. And then 52 plots the relationship between risk and return of the total fund versus the total fund target. And then that ellipse captures the 10th to the 90th percentile of the peer group. So the total fund has achieved a higher return than the target, but with more volatility. So bigger swings, but over time has outperformed. And then 53 looks at attribution. So when we look at the return for the last 1 year and the last 5 years, how has active management contributed and how has asset allocation contributed? In each case, for the last 1 year and the last 5 years, asset allocation has been a slight drag. Any small dislocations from the target, which will happen, has been a slight drag. Manager effect has been positive for the recent year and detracted over 5 years. The big driver of detraction from active management in the last 5 years has been international equity, public equity implementation. So we'll talk about the work plan next, but our plan for the coming year is to look at each individual asset category, domestic equity, international fixed, real estate, or real assets, and talk about the implementation of each. Is it still what the board wants going forward? Are the managers in place the ones that are still appropriate? 54 and 55 have performance for each individual asset category and each individual asset manager. The first thing that stands out to me, looking at slide 54, this is all of your equity managers, is that the returns are pretty phenomenal. In particular for the last year. The last year, every number, or every manager in every asset category was up almost 20%, between 20 and 34%. Pretty phenomenal. Longer term, no red numbers on the page. Everything has been gains. Even 10 years, Greg mentioned that the equity markets have certainly outperformed expectations, even over 10 years annualized. Our expectations going forward are much lower than those 10 to 15% annualized numbers that we see on the page.
Dan?
I have a question. So on charts 54 and 55, do we not have the figures for 15 years? Because 15 years would capture the 08 recession. It just seems like it's a little more balanced to include that.
Yeah, it's a good point. We've added 15 years kind of consistently throughout the report, and these pages don't have that. We can add that, so we will do that. As far as manager performance, I said equity managers, these are all the domestic equity managers, does not capture international yet. There are no managers on slide 54 that we have any concerns with. Overall, most of the managers have outperformed over longer time periods, mixed performance in the recent year, but no changes to any of the strategies or the managers that we have to point out today. There is one manager update that we want to bring to your attention on slide 55. It's specific to one of your international equity managers. T. Rowe Price manages an international small cap portfolio for the program. T. Rowe has announced that there will be a retirement. The head of international equity, a fellow by the name of Chris Alderson, will be retiring at the beginning of next year. So he'll be retiring, and they've got 2 internal promotions that are relevant to this strategy. The portfolio manager for this international small cap strategy will be promoted to Chris's position of head of international equity. That will officially happen again at the beginning of next year. In the meantime, they've promoted someone else internally that works on this strategy to be co-portfolio manager with Justin, who is the current portfolio manager, over the course of the next year to transition responsibilities. So a fellow by the name of Ben Griffith will be the new portfolio manager for this strategy starting 1/1/2021. We have a call and a meeting set up with the team in the next couple weeks, so we'll keep you abreast of what we learn from that. Our current thoughts are, this is certainly significant and a transition that we want to watch, but we appreciate that there is a long runway, they're being thoughtful about the transition, and it is internal promotions. There are folks that are familiar with the portfolio. The T. Rowe research team is very integral to the stock selection of this portfolio. That doesn't change. The relationship of portfolio manager to that research team will remain. So more to come there, but we did want to alert you as it is a significant change to the portfolio team.
Question?
Yes.
So on our domestic fixed income, we're showing the return on that 9%, and that's a fact as if we sold those bonds. But what kind of income are we actually, what's our coupon on those? What are we actually making on those?
So
That's sort of like if I put $1,000 in my savings account at Wells Fargo.
Yeah.
And interest rates drop, and now I say, hey, my savings account's worth $1,100 now. Well, guess what? I've still only got $1,000 in the savings account.
Well, if you sold these bonds today, you would have returned 9%
Right,
over the
which
last
we
year.
don't sell the bonds.
No, but it's kind of like stocks too, right? The stocks went up in value, but the dividend yield on the stocks remain about 2%. The dividend yield, or the yield on this bond portfolio, remains only about 2% too. So yeah, the current yield for these portfolios is 2.5%, 3%, call it.
Do we sell our bonds? Does our bond portfolio churn?
Well, the managers, Dodge and Cox and PIMCO, who manage the portfolio, they do actively trade bonds when they want to. But also when you rebalance, the group, or the investment program does sell bonds if you're overweight bonds, and then it adds to bonds if you're underweight bonds. So that 9%, if you did rebalance, in theory, you could be taking money, you could be selling bonds, but in this case, the stock market was up even more. So you're actually underweight bonds right now because the stock market was up so much last
And
year.
when they're trading in bonds, is that, gee, you're not as good a borrower today as you were yesterday, and you're a better borrower today, and so I can sell your bond, and I'll buy a bond. And so they're trading bonds within different corporations that have slightly different yields because of their perceived credit ratings?
Partially that, or, so that's a lot of what Dodge and Cox does. They have a lot of corporate bonds, and they decide the credit value and the relative value between corporations. the price of their bond. But then PIMCO will also decide, do I want to be in long duration or short duration? Do I want to have exposure to non-US yield curves? Do I want to be in agency debt, treasury debt, mortgages, commercial mortgages, corporate bonds? So they have a sector allocation. They decide which flavor of bonds they want to be in.
And what percentage of the profit that we make on that in any given year is from trading versus just the clipping the coupon? In other words, does that active management in the bond market make us money, or?
Yeah,
It does.
so, so the past 3 years, it's added about 40 basis points
Okay.
annualized.
Oh.
Yeah, so, so the bond market has been, it's been a pretty good place for active management for the last 10 years. Better than the US stock market for active management. Right? It's been harder sledding in the stock market to add value than in the bond market.
Last quick couple notes on this page, slide 55. Notably, the international equity portfolio did well last year. Up over 23%, and also ahead of the benchmark. This has been the most challenged asset category for this investment program, and so we were pleased to see a good year in 2019. 3 and 5 year returns for the international equity portfolio remain behind the benchmark. 10 years is ahead. And then domestic fixed income, Greg mentioned that it's been a good place for active management in the last 10 years. That certainly comes through in your portfolio as the two managers, Dodge and Cox and PIMCO, the combination of those two has outperformed overall. Real estate portfolio continues to be pretty steady. 2 core open-end real estate managers, domestically focused. Both are now seeing more return from income than appreciation, which is normalizing, really. Any questions on the individual managers or the portfolio performance? We have a few pages here that look at the ranking versus peers of each asset category. But as I mentioned before, we're going to spend a lot of time in the next year really diving deeper on the individual managers and the construction of each asset category, meeting by meeting. 56 has domestic equity. Last quarter was very good versus peers and versus the benchmark. And then longer term time periods, median-ish versus a peer group of other public funds domestic equity implementation. International equity on slide 57, again, has been the most challenged over time. We were pleased to see a good quarter and a good year. Fixed income on slide 58, again, has been quite steady with the combination of those two managers ranking about in the middle of the peer group in terms of other public funds fixed income implementation, but ahead of the benchmark over all time periods. And then real estate, lastly, on 59. This has, it does rank performance versus other core open-end commingled real estate funds. I think the role that your real estate managers play in the portfolio has certainly been additive, both from a return perspective, but also just diversification and having a different type of return stream in the portfolio. So we'll look to the infrastructure mandate to provide similar role in the portfolio, diversification of return stream and potentially dampening some of the volatility quarter to quarter. Are there any questions on performance or anything that you'd like me to spend more time on? If not, we'll flip ahead to the work plan. The infrastructure update, that's right. First, infrastructure. So as a reminder, there will be the board has approved a 6% allocation to infrastructure going forward. You interviewed managers last time, IFM and JP Morgan, and there was a decision to split the allocation between those two managers. IFM comes only as a hedged option. JP Morgan comes as hedged or unhedged. And I believe moving forward will be with the JP Morgan hedged version of the portfolio unless there's any objections by the board. We think that makes sense. Again, IFM comes only in hedged, and the hedged version of JP Morgan would take out that currency volatility.
And we talked about this at the last meeting, about going with hedged. But
As far as the process, the paperwork for IFM has been submitted. That is definitely on its move forward, just waiting confirmation back. Obviously, James and Robert doing all of the work on that. We're just reporting out. We take no credit. And then working with JP Morgan at this point to get those subscription documents as well. Any questions? Objections?
We like it.
Okay, lastly, the work plan. I also have hard copies of the work plan if anyone would like to look at the paper. In talking to James and Robert, we thought it would be helpful to take a look at the year ahead. There's a lot of work to be done, and to set a plan of what we will talk about at each of the quarterly meetings and the work that we'll be doing in the meantime. So the first quarter of 2020, that's our meeting today, of course. We've got the performance review. It does say investment policy statement review. That'll be deferred to an upcoming meeting. We reviewed Callan's 2020 capital market assumptions, and we've got the infrastructure funding update. Now looking forward, May, August, November meetings, and what we'll be working on in the meantime is, like I said, those deeper dives on each asset category. So at the May meeting, we'll be doing the domestic equity structure review. If there are any follow-ups from that, we'll work on that in the meantime and give that update at the following meeting, along with the international equity structure review. And then rounding out the year in November, doing the deeper dive on fixed income and real assets. Now with real assets, obviously, infrastructure is going to be happening over the course of the year, so that will be part of the portfolio by the end of it. We've depicted it on the bottom half of the page as well, visually if that's more helpful, but just to show the progression of that work over time. If you ever have a question about what we'll be talking about or what we're working on in the meantime, this should give you a good guide.
Claire, if I may, I just want to make the board perfectly, update you guys. It's not Callan's fault that the investment policy is not before you today, it's mine. So, it's been sitting in my inbox for a week. And
I actually think it'll line up well with the infrastructure funding update too, because a big change is going to be the update to the policy target. So we'll have more news to report on that next quarter, and that'll line up nicely with approvals if the board so sees fit.
Robert, are you having fun yet?
that's a chuckle, but not an answer.
yes, yes.
Let the record show.
Yeah. So the last thing I'll say on the work plan is, of course, this is a plan. It can certainly change. And if you have anything to add or shift around, please do let us know.
Thank you very much. This is really helpful.
I have a question. For all of you who missed the Callan conference, you really missed it. I think I was the only one there.
Robert was sick, I believe. Yeah.
3 outstanding speakers, all PhDs from Harvard, MIT, and Oxford, spoke on the future in terms of economics, in terms of demographics, and in terms of technology. And it was really interesting to see these people from different ends of the world, from different disciplines, their points of view intersected out about 10 and 20, 30, 40 years into the future, all looking from different corners. The targets all looked about the same. And those targets are, to me, seem far different than the targets that our actuaries are looking at. The changes in demographics in the world are nothing like we have looked at in the past. And I think it's, they're projecting decline in population, decline in GDP across the globe, decline in employment, just stunning changes in our world. And I don't know, what are we, where's our crystal, is it time for forward-looking people to pull out a crystal ball and polish it up a little bit more?
So do our Callan's capital market expectations take the risk associated with some of their forecasts into consideration? And I'd say yes. We say our baseline forecast for stocks is 7%, but there's volatility around that. There's uncertainty around that. And that uncertainty does take into the fact that some of the demographic issues you're alluding to is the graying, not only of America, but of across the globe, and lower workforce participation potentially for it. Though we did have another speaker who came and said, you know what, the people are going to live longer, and they're going to keep working too. So it's, it's not 100% clear which way to go. I think one thing that you might be alluding to is it's not so much what are people at traditional retirement age is going to do, but it's also the lower birth rates, right? And I don't know, we'll have to see if that actually plays out. I don't know how much human nature has actually changed. You know what I mean? Yeah. So our forecasts do take some uncertainty into consideration. We've been ratcheting down our return expectations. They're certainly lower today than they were 10 years ago. Part of that has to do with a slower GDP growth going forward. Yeah. But I thought a lot of the speakers were quite thought-provoking, and we really appreciate you coming, and wish Robert could have made it as well. Yeah.
It was an outstanding
We're
program.
glad you're good.
You didn't want Robert there.
He was
In quarantine?
yeah.
On that particular day, you didn't want him there.
No.
Greg, can
It
we
was
see, is that presentation going to be available to us?
Sadly, no.
Oh.
So actually, I had a few clients ask if they could see the hard copy of the presentation, and we actually asked the speakers, and they politely said no, because why do you need to go see them anywhere if they hand out their presentation?
Though, I looked them up on YouTube.
Oh, you
And
could.
they've had presentations at other venues
Yeah.
that are very, very
You say
similar
that back to back.
to what they had said.
Yeah.
I actually read Moira's book.
Oh, you did?
Yeah, the
Oh.
latest book, and it's pretty deep in the weeds.
Yeah.
Don't put you to sleep. I mean,
Freely admitted their
Yeah.
More dynamic.
this woman speaker, she is one of the 100, Time Magazine's 100 most influential people on the globe.
Wow.
I mean, it gets some real lightweight speakers.
Yeah. And I thought her comments about her board of directors work at Chevron was really interesting as well. It's a
Yeah.
very balanced discussion about how do you actually go green, how do you actually do impact, and how do you actually be ESG and scale it for an economy that needs energy. Yeah.
But her projections she brought back from the World Bank
Yeah.
were pretty sober.
Yeah.
The projections for growth in GDP across Europe and Africa. Well, I think Africa was the bright spot.
See what you're going to miss because you're leaving us?
No.
You could have gone.
Next time.
Yeah,
I
we would
still
certainly
can.
have to have all of it.
Love to have you next time. You know, we didn't mention up front, but James, congratulations
Yep.
on your
Thank
new
you.
position. We're very happy for you and the change that means for you. I think
Reasonably
that's
happy.
great. And I think that's great for you. And to the extent the association needs help along the way, we're always here to lend a hand if there's, from the investment area, if you need additional help, or of course.
You know any candidates?
Yeah.
We'll keep our ear to the ground.
Yeah.
Yeah.
Great.
Okay. Okay.
Great presentation.
Thank
you all.
Good to see
That's
you.
all.
Yeah, thank you.
Good.
Yeah.
Thank you so much.
Okay.
I think, how about a little break? Got 10 minutes.
We can do that.
Very good. Thank you, Madam Chair.
49.
9:49.
49, okay. And the next on our agenda is discussion and possible action regarding approval of cost of living adjustment as of April 1st.
Thank you, Madam Chair. Trustees, you have the memo from our actuary. I'd be happy to answer any questions you may have.
I move
Second.
that we adopt the actuary's recommendation and grant a 3% cost of living.
Okay.
You just want your name to do it.
As the third-party representative.
Any discussion?
Yeah, just a question. So when the actual CPI is over 3%, the extra is carried forward to the next year?
It goes into a COLA bank.
Okay.
If, so it's calculated, and if it's rounded to 3.5 or more, then the overage of 3 goes into a COLA bank that can be applied in future years. So if the COLA, if the calculation were
That's a lot.
3.14, that would be rounded to 3. So it has to be above 3.25 for there to be a COLA bank deposit, if you will.
And on the other side, it would have to be less than 2.75
Yes.
to be rounded down?
Correct.
Okay.
And that hasn't happened for a while, though, right? That anything's gotten thrown into the bank or? it hasn't?
No,
Yeah.
has not happened in quite some time.
Yeah.
I don't know when.
What would we do if it hit 2.75? It flip a coin?
I believe that's rounded up
It is-
at 2.75.
Yeah.
Because it is rounded to the nearest 0.5%, and I believe it's a round up. Although I don't know. We may go out past the hundredths decimal point.
Oh, it may, yeah. We would probably ask them to do that.
Yeah.
Because they probably already rounded to get to
Yes.
2.78. Okay.
Yep.
Okay, we're ready. All those in favor?
I,
Opposed? Abstain? Motion passes. Okay, next, discussion regarding quarterly budget update.
Thank you, Madam Chair. Trustees, you have the quarterly budget update that Robert has prepared with memo explaining some of the items. I'd be happy to answer any questions or call on Robert as my knowledge fails.
This is how it is before we increase for the,
Yes, this is the budget through the end of the second quarter of the fiscal year, so December 31st, and based on the budget in place at that time.
Just a question on 2B.
Mhm.
Is it possible to add in a projection for fiscal year end? We have the budget and the actual.
So what we've done here is, this is the, it's the so it's the budget to date. And we do the budget versus actual to date. So we allocate the annual budget amount to different months and quarters, and then roll that up in this report so you can see an apples to apples basis. We could do a projection. But it's a whole lot of guesswork, to be honest with you. And my default position on doing a projection is, what did we actually spend in the first 2 quarters, plus what's our budget for the last 2 quarters? And that's just going to tell you the same information you have here,
but on a larger scale. I don't think it adds a whole lot of value, to be perfectly honest. I would struggle to come up with anything other than the budget amounts to add to get to a projection.
Yeah, so, and I appreciate that. I just was thinking that if you know there's some upcoming costs in your projections, of course, you'll have to forecast the unknowns as far as the budget and your actuals, but there might be things that you're aware of that are coming up in the upcoming quarters, and so that can be put in the projected to give us sort of maybe an idea where we might land by year's end, so we can maybe control some costs if necessary throughout the year.
Generally, if we know it's coming, it's already built into the quarterly budget amounts. For example, the fiduciary liability insurance, we pay that once a year. We know exactly when that is. It's built into the budget that we pay all of that in that quarter, and we pay nothing the rest of the year in that item. So we already do that in building the month and quarter budget, the distribution of the annual budget amounts.
Well, it's an interesting question because accounting does that mid-year budget review. Well, every quarter we do a budget review, and then we have to do year-end projections. And oftentimes, it's just housekeeping, but it is helpful, I think, because I do the budgets for our department, and it is helpful to take a look, mid-year and see, okay, where are we at? But we have all the information here to see where we're at, and like you said, if we have anticipated costs, we've already implemented them in the budget.
Yeah, I mean, we could certainly add a projected annual to this report, I think. So we can look at that.
Okay.
So any other discussion on the quarterly budget update? If not, let's move on to agenda item number 6, the discussion and possible action regarding proposed budget amendment.
Thank you, Madam Chair. Trustees, you have the proposed budget amendment and the memo explaining the items. You see the only change here is the $60,000 in contract amount for both the executive search firm and the potential for contracting for other services that the board has discussed previously and directed to include.
I do have one question. What of the 60,000, what amount is going to the recruitment, and what amount is anticipated for an interim?
So I want to be mindful of some requests here. I would say the majority of that amount is for the search firm.
Okay.
And I'm happy to give more details offline.
Okay.
So.
Thank you.
Is it something we need to hold until after closed session?
No, I think this is fine.
Okay.
Okay, any other discussion on the budget amendment? Do we need to do an action on that? Or
Yes, I believe this needs adoption.
Okay, so.
What's the motion because the recommendation is to take action. So wouldn't it take,
Go ahead.
in the motion, wouldn't you say I move to,
I would if I hadn't put a lifesaver in my mouth just a minute before. I'll go back. I move staff recommendation.
There is no staff recommendation on this item.
Darn it, okay. I move that we adopt the proposed budget agreement as presented by staff.
Amendment. I think you said agreement.
Amendment as presented by staff, sorry, thank you.
Do you have a
Don't be
second?
too fast to try to
second.
get things over.
Any discussion on the motion? All those in favor?
Aye.
Opposed? Abstained? Motion passes on the amendment. And our number 7 is discussion and possible action regarding agreement with Brown Armstrong CPAs for independent financial audit services.
Thank you, Madam Chair. Trustees, you have the memo and the proposal from Brown Armstrong. My memo explains the reasoning for bringing this proposal to you. Their term is up. They've done good work for us. They've been very, very helpful. With all the other priorities and changes taking place in the organization, I think it is a worthwhile use of time to not conduct another RFP here. I would recommend just retaining them for another 3-year term.
I move staff recommendations.
Second?
Second?
Okay, any discussion on the motion to retain the same CPA firm? Okay, all those in favor?
Aye.
Aye.
Opposed? Abstain? Motion passes. Okay, moving on, discussion and possible action regarding resolution 2020-2021 defining compensation earnable pursuant to Government Code 31461 for members who are not subject to Government Code Section 7522.34, non-PEPRA members.
Thank you, Madam Chair. Trustees, you have the memo and the proposed resolution before you. Adding new pay codes and cleaning up so that our resolutions align with the county pay items. Would recommend approval of the proposed resolution.
Is there a
Don't
motion?
look at
to-
me. There
I'll
we
make a
go.
motion to approve.
Is there a second? Oh, you want to,
A second.
is there any discussion on the motion? Okay, all those in favor?
So just a
Yes.
little discussion that I think I missed the first time through. So it's being recommended that this not be included. Usually we include it as pensionable.
Correct.
Yeah.
This item, pay code 342 holiday bank paid, is not included.
Okay.
Similarly to CTO paid.
Correct.
Any other discussion? Okay, those in favor?
Aye.
Opposed? Abstain? Motion passes. Okay, moving on to discussion and possible action regarding resolution 2022, defining pensionable compensation pursuant to Government Code Section 7522.34 for members who are not subject to Government Code Section 31461, PEPRA members.
Thank you, Madam Chair. Trustees, this is the memo, same thing. Now this applies to PEPRA members. The previous version applied to legacy or non-PEPRA members. Would recommend approval as presented.
Madam Chair, I move to adopt Resolution 2020-02 as presented.
Second.
Any discussion? All those in favor?
Aye.
Opposed? Abstain? Motion passes. And now we're coming to discussion and possible action regarding Board of Retirement meeting calendar. And we're rescheduling for the May 2020. For Chad.
Thank you, Madam Chair. Trustees, you have a memo from me requesting that the board consider moving its May meeting from May 20th to May 27th. I would encourage the board to make this change if schedules allow.
I'll make a motion to approve so Jeff can have vacation.
Yeah,
No.
I'll second that.
Any discussion?
I appreciate too coming forward this much in advance.
Yeah.
Because that gives everybody an opportunity
Really
to.
thoughtful.
And we want Jeff here.
Between 3 daughters, ages 18 and 25, and my wife and my schedule,
Wow.
we appreciate your consideration.
We'll find out where
Easy
you're going
decision.
later.
Yeah.
Yeah.
Okay. All those in favor?
Aye.
Opposed? Abstain?
Thank
Motion
you.
passes. Okay. Discussion regarding administrative report.
Thank you, Madam Chair. Trustees, you have the administrative report. I will not belabor anything there except if you have not yet brought your check, do it
Can
now.
we find, do we remember, because it was so long ago?
Yeah, it was.
Are you letting people know that haven't, or, okay.
Did I?
Do I need to pay for
You don't
anyone
take
else?
cash.
Well,
For you.
here, does someone need $9?
Lee doesn't have a check.
Credit card.
And please be aware of
You want
Form
those
700 filing.
It's April
1st.
April 1st is the deadline, yes.
Turn it in.
And it's due to Judy. You do not need to send it to FPPC unless you have a requirement somewhere else to send it to FPPC, Dan and Sherry.
Okay, and Gina sent out from, the recorder's office sent a thing, I just noticed on the email this morning for us, so, and you,
Yeah, so
S3 probably,
I
yeah.
record there, then I just give her a copy.
Yeah.
Okay.
You just, yeah, because you haven't had to do that yet, right? I'll show
Yeah.
you. Has it been
Last few years.
Did you last year? No, but you didn't have to put Mendocino County retirement on, or did you? No, you did. That's right, because it's been a year.
Mhm.
Okay, so same thing you did, just
Yeah.
copy from us.
Just wasn't sure if it was separate filings.
Okay.
So it's all one.
Yeah, there's just a, yeah. Just record it once and give them a copy.
Okay, thank you. Do we have any other general member discussion? Are we completed with the administrative report?
Yes, unless there are other questions. Sorry, Madam
I
Chair.
have a question.
Yes.
Catherine, are you running for another office, or are
Yes,
you
I
going
put in my 2 cents.
to continue to be secretary, or
Yes.
to move up to do?
No, I continue to be secretary because, well, one of the issues is that part of our requirement as vice president is that we are very involved with recruiting speakers for the conference. And there are other people on the board who are more dialed into the network and, maybe have more time to go to other events and recruit people from other events. So I felt a little bit like if there's someone else who could do a better job with that, that's just fine with me. But, maybe at some
One of
point.
these days, to see you running the whole thing.
As with so many of these organizations, it's the president-elect or the vice president that really does a lot of the heavy lifting.
Yes,
It's a lot of work.
yeah,
So,
because our current vice president, Vivian Gray, she goes all over the place.
Yeah,
Constantly
Yeah.
going to events and looking at possible recruits.
yeah.
yes.
And if any of you have good suggestions, would really welcome any ideas or whatever. We're very open to that too.
Just a comment, and that is that people in the rest of the state do not realize or acknowledge the amount of time it takes to even get to a place that is added on when you live in a place like this.
Right, no, we're fortunate to have some representation because I'm sitting next to the chair of MCERA. She was, Los Angeles, and we're the smallest, they're the largest, and it's kind of, daunting at times, but I'm happy that one of us, it doesn't have to be me, but one of us to be up there and participate. Thank you. Okay, so is there any general board member discussion before we go into closed session? No? Then we're ready to go into closed session.
Yes.
I thought this was going to take a lot longer than an hour and a half. Good job, Madam Chair.
Reporting out from closed session?
The report out in the matter of Robert DiStefano, application for service-connected disability retirement. The board voted unanimously, except for Jerry Harris, who abstained, to grant the application. And in the recruitment for the executive director, the board gave direction to staff and council.
May I say, Madam Chair, when you do that, could you say Geraldine Harris instead
No.
of Jerry Harris?
Yes, I can,
Thank you,
next time.
thank you.
Okay, is there a motion to adjourn?
So moved. Second.
Any discussion on the motion? All those in favor?
Aye.
Opposed?
When you looked over here and pointed at me, I thought you were gonna say you look nice with a jacket.
Well, I-
So I didn't see my travel budget